Today, it's an important program. We're going to unpack what many say is the holy grail of the entrepreneurial journey. What am I talking about? Money, getting funding for your business. Now, finding the money, finding the cash, finding the right partner to invest in ideas, building and scaling your business is one of the biggest stumbling blocks I would suggest on this very difficult road on the entrepreneurial journey. I'd like you to consider this. Capital likes to be allocated efficiently. And if that's the case, how can we make sure that it is adequately allocated to who am I talking about? You, the entrepreneur. So what do you need to have in place? What kind of people do funders look at and really want to invest in? What type of businesses, I wonder, are they looking into? And what guarantees or security are those funders looking for? What we've done this time is we've gone out to two actual entrepreneurs, hard-working young South Africans, to really interrogate and to find the issues that they have had to deal with in this entrepreneurial journey of theirs. And we're going to try and answer some of the questions that they raise with two special guests with us here on Viewpoint. And I know they're going to bring a wealth of experience and knowledge to this very important funding conversation. Our first guest is Themba Mabizela, who has over 20 years experience in the commercial and business finance space. He's with FNB, and he's really seen it all kinds of funding and the different applications that come through his door. He'll be able to navigate us successfully. Joining him is Abu Cassim, who is a fund executive for Additive Capital, which is an early investor-focused organization, particularly in that fintech space. He's also the founder and the chief executive officer of Josie Angels. It's a well-known angel investor network. Gentlemen, to both of you, a very warm welcome. So, Abu, I want to start with you, Josie Angels, and correct me if I'm wrong, but the stated intention or the stated mission of the initiative is to change the funding landscape by helping more companies and specifically get through the early stages. Why is that important?
Our mission really is to change the funding landscape, specifically in the early stages of that funding landscape. And if you look at it, the landscape is almost shaped like an upside-down pyramid, balancing on a very narrow base. And that narrow base is the early stage funding space. Typically in a more developed market, you'd find that there'd be family and friends whose doors you can go and knock on. The average South African, unfortunately, doesn't have a rich uncle who can help you out in those early days. And so then angel investing is the next level up in that pyramid. And angel investing is external investors, professional investors who invest their personal money into your business. And even that is very thin. The level above that, I think we've done exceptionally well, is the VC space, where you've got a Section 12J, which has catalyzed a lot of the funding into the later stage startups.
VC being venture capital, yeah?
Venture capital. But unfortunately, none of that there hasn't been enough that's trickled down to the earlier stages of that funding landscape.
When we talk about early stages, are we talking weeks, months, years? What's the time frame? Or is it that perennial question of how long is a piece of string?
We have invested in very early stage businesses. So we have invested in pre-revenue businesses. We've invested at idea stage. But typically what we do look for is a bit of traction. Someone who's gone out, assembled a team, got a good team in place, and then gone out into the market and had conversations, has data points on their solution and what the market thinks of the solution.
And depends on the appetite for risk, I guess, and also perhaps commitment from the marketplace, surely.
Correct, yeah. Angel investors, they assume a lot of risk. And 95% of the businesses that start out, unfortunately, don't make it for whatever reason. And there is this assumption within the angel space that the risk is assumed. And we've got to help de-risk that business through investing in the business, but then also assisting that business through extending our networks and also our knowledge on the space.
Themba, let me bring you into the conversation now. You have an enormous amount of experience in the funding space, but let's be honest among the three of us here. This year has been weird, to say the least. The current climate in South Africa is difficult. We're dealing with the pandemic. We're dealing with the structure of the economy. There are so many variables that make things very, very difficult. What are you seeing in the financing space that is different? How are you reading the climate?
Thanks, Jeremy, for the question. There's been a lot of activities that have happened or picture that have changed in the spheres of businesses from customers. Firstly, you find that customers during the pandemic period, some of them, as and when for them to get back into their feet, majority of them, they not have borrowed before. But now, because either the payment from the debtors are delaying, and also the markets are not opening up as they used to. Some of them were exporting or importing. So the timeline it's much longer. So for them to be able to keep, the main thing becomes your working capital. So for them to must fill the gap of working capital in terms of more ordering stock, paying salaries, all the operating costs. So you find that majority of companies, especially on the smaller end where they don't have the bigger balance sheet to sustain them, they actually come for funding. Funding becomes the major thing for businesses to be able to get back into their feet again. So it's definitely becoming one of the main important things, because some of the businesses unfortunately folded. They couldn't, because not only because of them, because of their customers at times.
Now I think it's important that we have to understand when a business is actually ready for funding. I want to break away from our two guests now, and I want to introduce you to two young entrepreneurs. Their names are Lindo Makhaye of Lusizo IT and Lomo Senoamadi of Bashumi Investments. This is what they have to say about getting ready for funding. Have a look, and then we'll pick up the conversation.
I'll be honest, I only had one focus, and it was putting one brick on top of another. I did not focus on trying to raise funds for the business at all. The nature of the business that I was in meant I service clients and customers their homes. So I'm able to raise funds through the service that I offered clients on a daily basis. So every single day I'd come back home with either the 300 rands, after that will be 500 rands. And as business grows and people tell each other about the business I do, it'll grow to 8,000 rands a day, that sort of thing. So that's how I generated the revenue to grow my business. And from that revenue, I was able to buy more resources.
When it comes to ESG programs, my advice to entrepreneurs is for them to research the company. It's very important to understand and research, check out the previous programs. But when they look at the program,
So what we've heard there is it's a real sweat. It's very, very difficult. Gentlemen, back to the two of you. And Abu, to you first of all, what do we mean by funding readiness? Maybe that's a good jump-off point.
As an angel investor, as a venture capitalist as well, there are 6 things we have on our wish list. So the first thing is the team. And for an angel, that's extremely important. When we assess the team, we assess the technical capabilities within the team. We assess the passion. We assess the domain expertise. The next thing we look for is the solution itself. Is the solution something different to what we've seen elsewhere? And in the startup investment space, we've got a saying that we'd rather invest in a painkiller over a vitamin. So a painkiller is a solution that's solving an unmet need. A vitamin is a similar solution to something else that's already out there, but just solving it in a better way.
So it's, if I'm hearing it correctly, it's got to be different, but for goodness sake, it's got to be practical as well.
Correct. Yeah. And it's usually the market that's going to give you an indication, that your customers that is going to give you an indication of the practicality and the use cases. And so traction is the next thing we look for.
What does that mean? How do you define traction?
Traction is paying customers. So those, whether it's a B2B or B2C solution, Have you got customers that are paying you for what you're offering?
And what else is on the list?
Then you've got the market size. How big can this get? Is it a fit for me as an investor? We typically invest, we are investing our own money. So we typically invest in companies and sectors that we're familiar with and in people we can relate to.
So what do you say then to an entrepreneur in terms of expectation when it comes to resource commitment in that funding journey?
It's going to take you the best part of 6 weeks to get this over the line. Most importantly,
6 very anxious weeks for some people. Yeah,
6 anxious weeks.
Yeah,
I think investor relations is extremely important. So we're not going to invest in people we don't know. And it's always best, my advice to entrepreneurs is go and start a relationship with the investor that you have identified. And then when the funding is needed, it comes a lot quicker and a lot easier.
What about the use of a consultant? Is that a good idea?
In the very early stages, I don't think there's enough margin. So I'm talking seed stage, early stage funding when you're starting out. But at a later stage, I have seen startups who then invest at that very next round of funding, which is called Series A round of funding in the startup space. I have seen consultants being used, but then the rounds of funding are a lot bigger.
So, Themba, to you now, at what stage in this business life cycle that we've just been talking about does FNB consider getting its feet wet?
So as a bank, we get involved in any business as long as it has gone through or passed the concept stage. So meaning there is a product that already exists and there is a service that is being delivered. It means the customer or the entrepreneur has actually identified the market that exists. He already knows what it does. It should not have been at the business plan stage. The entrepreneur needs to be aware that financial keeping becomes important because now when he sells 3 products, to be able to show this is how I run my business, this is how I keep my record, then there's a bank because then we get involved in financing him.
Entrepreneurial businesses are often passion projects. What do I mean by that? These are businesses that are born out of a person's deep appreciation or understanding of an idea, a dream, a concept, something that has moved them in their life. People invest in their dreams. There's nothing wrong with that at all. But often there is a point where they're going to have to give up control. I want to talk about that now. Once again, setting the scene for us, let's listen to Lomo and Lindo.
I still own 100%, but naturally, when the business grows, there will get a time where you will need funding, and investors. I see them as people that provide funding in a way. So I'm open to that if the business gets to that point. But currently, I'm still 100%. It has happened before, where I was requested 25%, but the transaction, it didn't make sense to me because I could see that the type of business that was proposed, I could have succeeded without a funder. The investor must be someone whose beliefs is in line with my beliefs, the culture that I have in my company. They have to speak to each other. That's the basic thing for me. And if it's someone that is trustworthy, that can also that I could also learn and grow from, with them.
This is my lived experience. I've lost a business to somebody I believed would have been a great partner because they had a very strong financial muscle, and they felt, no man, they can't be sharing that revenue, so much revenue with me purely because I was young at the time and they were quite grown. Maybe this is just an isolated incident, a bad example of what happens. I think it is possible for a good mutual beneficial arrangement to coexist, where one can have a great investor in their business who adds a lot of value, and they're able to grow their business, and they're able to share on the spoils equitably on whatever the revenue they generate in the business.
We've looked at the negative side, but I'm also assuming there's a positive side to giving up control. Sometimes it's not a bad thing, is that people who are coming into your business are going to add real growth value. I'm sure I'm correct in saying that. So what elements then should an entrepreneur consider when faced with this crucial junction? And I imagine it happens maybe 18 months, 2 years, 3 years into a business.
Angel investors and venture capitalists, for that matter, bring three things to the table: knowledge, networks, and capital. Often the starting point of a conversation is capital, but actually the real value comes post-investment when we're sharing our knowledge and networks in that space, and we help grow the business.
So the final aspect now, gentlemen, that I want to look at in the whole funding dynamic when it comes to entrepreneurship are the different types of funding that are available to the entrepreneur. Presumably, we want to finance in order to invest in the business. So once again, let's listen to our two entrepreneurs, Lomo and Lindo. Where did they get their funding from?
As you know, with the banks, as a startup, if you don't have any collateral, it's very difficult for them to give you any funding. So I wasn't eligible to get any funding from them at all. I used my retirement funds from the early 2000s to start for my business. It carried me for, I would say, for the first 2 years. Then there were now and then where I will find orders where I will ask my family. My mom has helped me with her retirement fund. She helped me to fund one of the projects. And I also had a friend who also, actually my business has been funded by retirements, come to think of it. My friend also had just resigned, and she also lended me money from her retirement fund. Then that's where, after those projects, that's where I had a little bit of capital to continue to. Then it just started growing gradually until where I could sustain myself.
All entrepreneurs, and I think it's safe for us to say this, are always hungry for cash. It's tempting to chase any source of revenue that you can, but there are pitfalls, obviously. It's a question to both of you. You got to be careful here, haven't you? Don't be seduced by the dollar signs.
Yes. As a bank, we've got a variety of funding instruments that are available to entrepreneurs. I'm just going to mention 4 streams at which there's quite a number of products in between. Starting with the working capital. It means he wants to be funded in terms of stock, in terms of salary, or bridging working capital for a short period of time. There are a lot of products in between your overdraft, your invoice discounting, or your single invoice discounting, your letter of credit. There's quite a number of products that come into that part for a short-term funding. It's important for the entrepreneur to understand his funding requirement is a short-term or a long-term. The other stream I can also talk about is your CapEx. Entrepreneur could come and say, now I need to buy the truck or that buggy that I want for delivery. He needs to make a decision and say, okay, do I want to buy it or do I want to rent it? Because those instruments are available for us to say, do you want to, if you rent it, then the servicing does not become your part. Those are decisions the entrepreneur has to make. And then we fund via the asset finance, the equipment, or it comes and say, I need to buy this property, where we do the commercial property finance. The other option also is the enterprise supply development, which Lomo mentioned, that actually came from one of the corporate companies where you become part of the structure in terms of the funding. It's another option that's available, meaning that an entrepreneur in your supply of the product, the corporate becomes your funder in the entire instrument. So that is one thing that Lomo utilizes in that part. And the final part, just to mention, is the equity component, which my colleague has just been mentioning. If an equity component is required on limited extent, as a bank, we do look into equity funding as well.
Let's look at equity options if we can. Obviously, there are a range of equity financing options. How does an entrepreneur approach that, and how do they look at different risks attached to the different options?
Within equity finance specifically, there are 3 different instruments. So the first is straight equity, and that can be through the form of ordinary shares or preference shares. And then you can do some smart structuring around that. You also get a convertible note or convertible loan. So that sits on your balance sheet on day one as a debt instrument and then converts to equity at some point in the future. And then there are new developments in the venture financing space that have come from elsewhere. This particular instrument is called a SAFE agreement. So it's a simple agreement for future equity and essentially is a gift on day one, but then converts to equity if the business is doing well in the future.
I want you to leave our viewers today with 1 or 2 points that an entrepreneur needs to look at closely when they start the funding journey.
I think the first thing is to do your homework, do your due diligence on the investor. Often it's a one-way conversation, the due diligence process, where the investor is asking you questions on your business. Important as an entrepreneur that you also ask questions on them or of them. What businesses have you invested into? Can I speak to those entrepreneurs? Get a sense of how you've helped their business, and do a 2-way due diligence. Get to know who the person is behind the money. This is a marriage, so they become partners in your business. But if things don't work out, it could be worse than divorce.
Thanks for that. Okay. And Themba Mabizela, I'm going to give you the final word. Let's try and keep marriage out of it.
Thank you. I think one word in closing for me that is very, very important for entrepreneurs to know is that when they're looking for funding or deciding for funding, expertise and knowledge is there. It is ready for them. They don't have to necessarily navigate through all the options. We've got relationship bankers who do that. Information is available to be able to guide them. And as long as they keep all the records, as long as they make sure that they disclose whatever we require, their help is there available. As the motto goes, how can we help you?
And final word. You'll both agree with me that even though there are so many difficulties that entrepreneurs are facing in South Africa right now, we're not going to go through all of them again. This is a good time to start thinking about it, isn't it?
It is. In actual fact, as the saying goes, that people who've made lots of money, they actually made money on the downturn of economy. Quite frankly, we see quite a few entrepreneurs who are coming to the fore and say, this is an opportunity. I know for a fact it is going to fly. And as a bank, we come and assist.
Last word to you.
Yeah, it is time to build. I think we've got the talent and we've now got to export some of that talent, some of those products internationally.
Gentlemen, thank you very much for the information, the insight. I do appreciate you coming on Viewpoint.
Thank you.